Hi, my name is Hannah, and today we will interview Greg. A serial entrepreneur, Greg previously co-founded and chaired four other successful fintech startups in Asia, including Credolab, Flow, Solarhome, and AsiaKredit. Before that, Greg was the founder or CEO of one of the top private equity-backed success stories in consumer lending in Eastern Europe, Platinum Bank Ukraine, which he exited in 2013 for $150 million. Today, he gives us his view on key trends as we emerge into a post-pandemic world.
This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HCJ.tax.
We're live. Greg, good evening. How are you?
Good, Derren. Thanks. How are you?
I'm pretty good. Thanks. Thanks for giving me some of your time. I know you're a super busy guy. So for those who may be watching on YouTube or listening on one of the podcasts, can you please introduce yourself, Greg?
Sure. My name is Greg Krasnov. I'm the founder and CEO of Tonik. Tonik is a digital bank startup. We received a bank license, full bank license in the Philippines, and are in the process of preparing our launch. I'm a serial fintech co-founder, I suppose. I've also co-founded a few other fintechs around Southeast Asia. Prior to that, I built and sold a consumer bank in Europe with private equity backing. So been in and around consumer finance space for quite some time.
Okay, all right, that's great. So I want to start where we are right now, which is given this pandemic, right? The health crisis that we're all facing. Obviously, before this thing got as bad as it is, fintechs, they had a lot of support. They were, it was a space that lots of people wanted to play in. Do you see, not necessarily your situation, but in general, fintech in startups in emerging markets, do you see them being impacted by what's going on?
I do. I actually see, well, from an operational point of view, let's separate operational point of view and financing point of view. Operationally, actually, this crisis has been paradoxically really good for a lot of people in the fintech space.
Wow.
The payments startups have flourished. Basically, with people sitting at home and not being allowed or not wanting to go out, they've been trying to revert a lot more to using various digital means for payments. So volumes in that segment have increased by multiple in some directions, in some lanes. The multiple is over 10x, so order of magnitude type of difference. Other things that have been impacted very positively operationally, for example, SME-related fintechs. So all sorts of solutions for the SMEs to bring their finances online and really manage the business in an integrated fashion in a distributed architecture. A lot more people are now having to do that. So these guys are going through the roof as well. Digital banking, our segment, has been obviously another beneficiary. So all things related to finance, whether it be payments or taking loans or savings. Savings rate, interestingly enough, has actually gone up in most of the economies in the world. It's really strange by the sound of it, but if you think about it, point one, people don't have as much propensity to spend right now because, when you sit at home, you don't go out to restaurants, you don't go to the malls, stuff like that. So by nature, you just don't spend as much. And another thing that's happening is people are more concerned about their future, so they save up some more, and more propensity to just put money aside for that dark day, should it come. So savings rates going up, and people are looking for ways for their money to work harder and to be more accessible more easily. And these are all things that fintechs, including ourselves, are trying to deliver. So operationally, the segment has actually been a net beneficiary, I think, of the COVID situation. From the financing side, there's the financing is kind of splitting into the haves and have-nots all over the place. And I think the VCs are looking for shorter path to profitability. There's definitely a lot more pressure on the management teams to deliver revenue as well as profit, and not only market share. So we're seeing, even in my space, digital banking, a bunch of startups have had to raise money at deep discounts to previous rounds because they haven't been able to find that monetization path yet. And so they're burning a lot of money and VCs are discounting them. So this is happening in all other sectors that I'm familiar with as well. The VCs are much more sensitive these days to profitability.
Okay, so those are two angles. I'll take the first one. So savings. When you say savings has gone up, do you mean like marginal savings rate, like a percentage of, or absolute amount of cash? There's like more cash being stashed away right now.
There's actually more cash being stashed away. If you look at most of the economies, you will see that retail deposits are going up, which is kind of weird. There's also a flight to safety. So people are, much more reluctant to give money to companies that don't have, government guarantees. So, for example, we have a bank license, which means we're insured by the Filipino Deposit Insurance Corporation, right? So it would be easier for us to attract those flows than for a startup that just offers a fund product that is not government insured. So there's a flight to quality redistribution, money flowing some out of the money market funds and into the normal savings accounts. But net overall, retail deposits in the banking system, which is the insured part of the deposits, are going up.
Okay. And when you say a flight to safety, is it, do you see it by geography as well? So for example, I was speaking to someone yesterday who was talking about how much the assets under management in Singapore have spiked in the past 6 months or whatever, as cash comes in from neighboring jurisdictions, particularly from Hong Kong, obviously. People seek the relative stability of Singapore. So when you say that, is it a function also of where you're situated? Or is it just absolute numbers? You even look at emerging markets like Philippines, Indonesia, and you see savings going to be jumping.
I think it's more driven by the consumer psychology. And the consumer psychology in a place like the US or UK or continental Europe, people are not used to banks going bust. In places like Philippines or Indonesia or some places in East Europe, people have seen banks go bust and they have lost their savings, or they have friends or relatives who've lost their savings when a bank went bust, or even if they were lucky enough to ultimately recover the money from the government, the government doesn't immediately pay that money out, right? It's a process that can take many years, even when it is government insured. So I think what you're seeing when you're talking about inflows into a place like Singapore, Singapore is obviously a magnet for all the money from the places around, especially Malaysia and Indonesia. That's a very big destination, being Singapore. So I think, yes, Singapore is probably a beneficiary of that particular phenomenon.
Okay. And to your second point about VCs. So I'm thinking pre-health crisis, and I guess even pre-WeWork, because to me, WeWork was like a watershed moment as well. So, any guy with a good idea and it's tech related, here's $1 million, right? I mean, I'm exaggerating, but the point is made. So I guess some people would argue that there was a slowdown in that appetite to risk even before the health crisis. So you're saying that on this side of the equation, that de-risking is increasing. People are looking for, as you say, a surer path to safety. So one would expect there to be a shakeout of sort. People who really didn't have a way of making money and they were just looking to scale.
Absolutely. There's definitely going to be a continued shakeout in the startup space. So people who haven't found the path to monetization, I'm seeing this, in digital banking space, for example, it's very, very pronounced now. You've seen a lot of capital flows, digital banking, neo-banking, so-called, has been the largest beneficiary of the fintech investing, having absorbed billions of dollars around the globe in the last few years.
Mhm.
So what you see, digital banking basically has two ways to monetize. One way is payments, and the other way is loans. And payments is a highly competed area where if you want to make money, you need to be one of the top two players in the market. And the market has funded, the investors have funded up to a dozen of competitors per market.
Yeah.
So, those types of guys, various wallets, etc., guys that are planning to monetize through payments, they're not going to monetize through payments. They're upside down even on the customer acquisition cost level, the customer lifetime revenue. Loans, people are kind of coming back to the basics that, bankers have known for many, many years that, hey, the way you monetize a bank is you make loans, take deposits and make loans. And guess what? You cannot do that with current account money because current account money is immediate liquidity. So you cannot let it out for 2 years or 5 years. What you need is to match your assets and liabilities. So you need to take term deposits, 2-year money, 3-year money on the liability side of the balance sheet to be able to lend on the asset side something that you can make some profit on. So I think there's like a very clear separation. And for example, in Russia, an announcement just a couple of days ago that Yandex, which is the Russian Google or Baidu equivalent, has just acquired the largest digital bank in Russia called Tinkoff Bank. And they acquired it for $5.5 billion. The valuation that would make most banks cringe. The multiple works out to, over 3.5 times price to book. It's very, very, very high multiple for any bank anywhere in the world. And that bank is, monetizing very well. Last year, they made 70% return on equity, which again, average is about 11% globally on return on equity of the banking sector. So, and they're monetizing through loans. Yeah. They've monetized by becoming Russia's #2 credit card provider. And they have about 11 million clients, very, very good and solid franchise funded with term deposits and savings. So that's the haves, and that's tremendous value. And now, the tech giants, as we know, all trying to push into fintech space. So Yandex following the trend, buying the largest digital bank in their market. On the other hand, what we've seen is, guys like Monzo in Europe and a couple others having had to raise rounds at discounts to their previous rounds because they have not cracked that lending equation. So very, very clear separation of haves and have-nots. Over time will lead to a shakeout.
Right. And I guess, okay, so back to basics, take deposits, make loans, but in a situation where balance sheets are contracting rather than expanding, doesn't that also present itself with a layer of risk as well?
It really depends on what kind of lending you do.
Okay.
I think what I've seen is that consumer lending, for example, the demand is certainly always there. Good times, bad times. You will have less demand, interestingly, in the tough times because people will be reluctant to take more obligations. So, you always have the desperados, but the normal customers, they're actually more reluctant to take one additional obligation. So you have a little less demand, but you have significantly less supply, because what happens is the banks shut down this business typically during the crises, and they reserve whatever liquidity they've got to save their corporate clients, because it's a big for defaults that can really screw them up with the regulator and with their ratios. So they basically just shut down consumer lending. And the previous bank that I built in Ukraine, who were lending consumer unsecured in 2008, 2009, we were the only guys remaining standing. On a vintage basis, my profitability was best ever in 2009 and 2010. And 2009 is when I turned the corner on net income profitability on my bank because it was so much profit. We were cherry picking the best customers, the lowest risk, the rates because nobody else was lending. So it was a cool time to be in the market. So I think it's really, you know, if you have the risk models
Mm-hmm.
to drive the profitability of the asset products or the lending products, you can do well. But you need to be very, very careful. So right now, for example, as we're launching Tonik, you know, we're mindful of the fact that we haven't yet calibrated our risk models. So
Mm-hmm.
we're going to come out with a semi-secured product, which will mitigate our risk a little bit through some security on the account.
I gotcha. And okay, so stepping back, given what's going on, what is your outlook for the economy in the Philippines and Southeast Asia in general?
Yeah, that's a $1 trillion question, isn't it? I think what was interesting for me is just a couple of days ago, the statement by the World Bank. I don't know if you caught the same release that IFC has released this kind of big red flag saying, guys, we've had a health crisis, and the crisis has led to an economic crisis in most places in the world. Now, the economic crisis has a high likelihood of triggering a financial crisis, which hasn't come yet.
Okay.
Because basically what we've seen is that the regulators all over the place have put these moratoria on repayment of loans, servicing of loans. So the true state of the financial sector has not yet been revealed because we don't truly know in most places that have been hit by COVID, what is the level of NPLs. Now, you know, I suspect that, you know, it could be up to half of the economy that is actually not in a position right now to be servicing their loans. So, you know, when half of the economy is not servicing their loans, you know, you could have a major banking crisis. And that could have huge repercussions on the rest of the economy, because when the banking sector crumbles, you know, credit crumbles, you know, everything just kind of follows into the spiral. So that's my biggest concern right now. The governments have done, you know, wonderful job of dropping helicopter money all over the place to support the consumer. They've done some money in the US. It's been, you know, massive to support the capital markets. So capital markets are in absolute la la land from where I'm sitting. You know, I mean, these guys are so high on this stuff that, you know, they don't know which way is up, which way is down. It's just like, yeah, I mean, we're talking college days high. I don't think it's realistic to expect what the capital markets are showing right now as the future. I think that the realization is still ahead of us.
And so what we're saying, if we carry that through to its logical conclusion, that when that realization comes, there will be some sort of correction.
Yeah, that would be the expectation. Clearly, you know, the Trump administration in particular is very, very keen to, you know, support the capital markets because, you know, Mr. Trump weight, you know, the asset for the economy, which is not the same thing, but okay, fair enough. So yeah, well, look at the stock market; it's doing really well. So I'm doing great, you know. But like that's not going to last forever because also the U.S. You know, if you look at the U.S. and how U.S. has been financing itself, you know, whatever you know might be said about what China has done, you know, with U.S. on trade, imbalance has led to China having been #1 purchaser of U.S. Treasury over the last 2 decades. And China is the #1 holder of the U.S. Treasuries. And I think China's appetite for additional U.S. Treasuries right now is like negative.
Yeah.
So it's not like zero, it's like negative. So, and, you know, so the only way out is to print money. But you can't print money forever without ultimately triggering some sort of a confidence crisis. And when the confidence crisis happens, you get a spiral, you get, you know, the 1930s Germany hyperinflation type of stuff. And that could be very, very dangerous in terms of the society and the political repercussions.
So I guess there are multiple timelines or pathways going forward, right? On one extreme side, you have the Great Depression all over again, right? And on the other side, we can have, well, you know, like we've been doing since the GFC, we can just keep liquidity going and, keep stumbling along and kicking the can down the road for a while to come. But where do you sit in that continuum?
I'm the eternal pessimist on this stuff.
Yeah.
I'm a very old school guy, Darren.
Mm-hmm.
Like kind of 1 + 1 = 2 kind of guy.
Mm-hmm.
So to me, I don't understand, how you can keep kicking the can down the road without getting your house together.
Yeah.
The first 10 years of my career were in private equity, leverage buyouts.
Mm-hmm.
So that really taught me a lot in terms of, basic profitability models, EBITDA,
Mm-hmm.
have like when you've leveraged the company to the tune of like 6 times EBITDA, you get like really sensitive to things like maintaining EBITDA, right? And maintaining a solid financial position. So I think, I've had a good training early on in my career in that regard. And to me, because of that, the public finance side of things remains a mystery, how you can, do very, very irresponsible monetary and fiscal policy and survive. I just don't think that's sustainable forever. At some point, something's got to give, right? So it's very hard for me to predict when.
Yeah.
Last time we had a confidence crisis in the financial sector in a big way. We haven't had a major confidence crisis on the top tier sovereigns. The tier sovereigns crumbled, but not the top tier sovereigns. But we have seen a derating of the US as a result of the GFC. And the US is not doing itself any favors right now by doing all this money printing and all the fiscal madness that they're doing, right? So I think, at what point does the confidence of the, demand side of that capital markets equation say, hey, enough is enough, in God we trust, but do we trust in the Treasury of the United States? We trust in the dollar enough to maintain it as a reserve currency of the world, which right now is like 60% of the global reserves are held in US dollar, right? Russia is, very proactively moving away from that. China is now mega proactively moving away. China has introduced in the last year some very, very interesting initiatives on the blockchain to basically try to migrate away from the USD dominance by doing some crypto mechanisms. I think that's not a lot of people are catching on to that, but the full weight of the Chinese government behind the crypto mechanism could really do a really nasty thing on the US dollar.
Okay.
So I think, it's remains to be seen, man. There's a lot of different factors at play, and personally, I'm a little negative, but I'm always a bit of a pessimist. So
okay, so I mean that always makes sense, right? Hope for the best, but prepare for the worst. So that way you should be okay. But I'm interested in what you said, just a bit ago about China doing stuff on the blockchain, because that's unfamiliar to me. Could you talk a bit more about that? Because the last I heard, like China was not supportive of crypto. So yeah, could you talk a bit about that?
In the last few months, there have been some announcements whereby basically the Chinese central bank has stated that they are creating a digital yuan.
Okay.
I mean, I'll be happy after the call to share a few articles with you if you're interested in the subject. I'm not really deeply into the crypto space at all, because I haven't believed so far that without full government, like if you're going up against the government's ability to print money, eventually you'll get crushed because government will be stronger than that initiative. Right? But when you marry, the advantages of crypto infrastructure with the full strength of the Chinese central bank, that could be a very powerful thing. So.
Okay. That is interesting. That is interesting to know. So I know that they were looking at ways of challenging, the whole SWIFT BIS US dollar system with its own, that was part of like One Belt, One Road. But yeah, that would be kind of interesting because to a large extent, as an outsider looking in, the whole blockchain crypto space has kind of like overpromised and underdeliver. A few years ago, it was, oh my God, the world is going to change. If you're not in, you're going to lose. If you snooze, you lose. But, hey, look what happened, right? Yeah, but you, I mean, putting China aside, what is your outlook on blockchain crypto?
You know, I don't really have much of a view on that. You know, I haven't spent the time to educate myself about it. My very kind of superficial view of it is, you know, comes from I coded my way through college, right? I basically that's what I did. Like, and I coded. This was, we're talking early '90s, and
Yeah.
back then there was a thing called Paradox, Borland's Paradox, which was the first relational database software, right? So I was a coder like in those days on like database, which was like a big thing back then, right? Oh, database, you know, like so. To me, like, okay, what is fundamentally different about blockchain than about, you know, some sort of an environment of database like that? There's not that much of a difference, right? It's the safety, security that is promised. There are maybe a few niche applications for that, but fundamentally, there's like multiple database technologies out there that compete with each other. So I think, to me, like, I haven't really understood the promise of that and the hype around that. And at the same time, I've seen so much hype. You know, man, when like my friends in Europe are calling me and these guys are like so removed from anything technological, etc. And they're like, I'm being offered like this amazing deal on like cryptocurrencies. Like, should I do it? Should I do it? I really want to do it because, like, you know, tell me I should do it. And I'm like, dude, don't, right? Because, like, you know, like, it goes down to that level, and it's like the lower part of the middle class is being sold these schemes. You know, the theory of the greatest fool, right? Who is the next greater fool? So, you know, like, you know, once it's reached that level of the population, pretty soon it's gonna tank, right? Because like there are only so many tulips you can sell, you know.
Yeah, which was the situation before the Great Depression as well, right? When the guy, the shoeshine boys were giving stock advice, that's when you knew it's time to get out.
Every single, you know, every single spiral like that, like it ends in tears and has all the same symptoms, and you know, from the tulip madness or whatever it was, 16th century in Holland, and there's a couple books on this that I did take the time to read and was very, very educational for me probably a decade ago, to kind of understand how this works. It's, you know, popular psychology. Yeah, people get excited. You know, we're not rational beings. You know, what macroeconomists would say, we're not rational. You know, we get excited and then we get depressed, and you know, you allow those feelings to flow into the capital markets. You know, bad stuff happens. So
greed and fear.
Yeah, absolutely.
So going back to banking though, just generally speaking, not talking about the Philippines, but just generally, what is your outlook for traditional like retail brick and mortar banks? Do you think that their days are numbered, and invariably a physical branch will be a thing of the past?
Short sell. You know, like, this is like a short answer. Longer answer is, I mentioned this Russian digital bank that was just like very hot in the news, Tinkoff. Yeah. How are these guys getting 70% ROE, return on equity, when the banking sector globally gets 11%? How, right? There's some very clear drivers behind that. Basically, you know, banking has a value chain, and within that, it's origination, risk management, so cost of risk, cost of origination, cost of risk, cost of servicing, and funding. Okay, so traditional bricks and mortar banks, the thing they got going for themselves is their cost of funding is relatively low because people are familiar with the brands, you know, so they can attract money at low deposit rates. But they have astronomical cost of servicing because of the branch infrastructure, and cost of origination, same, because they're relying on, you know, the vanilla advertising and the branches to bring in customers. They haven't taken the effort to automate much of their servicing. So, for example, there are some very exciting things happening in the collection space, contact center space, where you need, you know, an order of magnitude less humans than you used to. You know, ultimately, it's all going to be driven by AI and bots. You know, the voice response systems are getting to a point where, you know, another 5 years or so, and it's going to be hard to realize you're not talking to a human. You know, and that technology is basically, okay, you have the CapEx that's going into that, but it's not compared to the cost of humans doing that work, right? So those costs are significantly lower, and cost of risk. what I'm observing is, I was a co-founder, for example, of a company called Credolab. It's today the market leader in Southeast Asia in alternative credit scoring. They have something like 80 banks and financial institutions on the platform. What they do is they take the data on your smartphone and they use that to help the bank make a credit decision. And the consumer, that's applying for a loan, he's usually happy to, okay, no problem. As long as you're not like going to use my personal data for anything else, like promise me that you're going to dump it as soon as you evaluate it, then no problem. So, and what we see is that type of data is extremely predictive of consumer behavior. But again, you need to know how to work it. You need to be familiar with predictive analytics and, machine learning techniques to really extract the value and the predictiveness out of that data. And a lot of the traditional banks have no idea about that. So if you look at a place like Philippines, for example, the per capita penetration of unsecured consumer finance in the banking sector is about $80 per capita. Now, compared to even Indonesia and Vietnam, like those places are at about 300, $350. China is at like $800. In Malaysia and Thailand are at average of $800 to $1,000 right now.
Wow.
So, a lot of the traditional banks are just, they don't know how to go and evaluate that middle class that maybe hasn't borrowed formally from the banking sector before, maybe doesn't even have bank account. 70% of Filipinos don't have bank accounts. So traditional banks have no idea how to evaluate them and how to assess and how to minimize the risk, that credit risk part. So, I think, and without going after that business, I don't think they can maintain their profitability over time because they will just get squeezed by contenders like the bank that I'm building.
Right.
We will not, be benefiting from the same price point as the traditional banks are establishing. We will be dropping the price point across all sectors that the banks are competing in. So I think over time they will either have to reinvent. The smart ones are trying to reinvent themselves. So you see guys like DBS, CIMB, UOB, they've launched separate franchises. So DBS Digibank, for example, they launched as purely digital proposition. So in Indonesia and in India, DBS doesn't have any branches because it entered the market as a purely digital proposition. So that's smart. Basically what they're doing is they're kind of trying to reinvent themselves. And hopefully they will have some platform that when Singapore gets disintermediated, by the new digital entity, they will say, okay, now we switch all of our clients in Singapore to Digibank purely, and we shut down all the branches as well. Yeah, but it's like the guys that are doing that, it's only like this compared to all the traditional banks out there.
Yeah, and for me, it's just like a regular, retail consumer. I found that, I look at the economics of it now with the whole social distancing, the number of clients that can be serviced in a branch, a fraction of what it was. So even if it was not economical previously, hell, no way is it going to be economical right now. And I'm one of those that believe that this social distancing thing is not going to go away. So I see what you're saying, but I want to jump back to another point you made about alternative credit scoring. That seemed really interesting. So is it like you use data points from like social media, like Facebook and Instagram?
No, media is a very poor data source for that. Basically, the reason being, and a bunch of guys tried to do that on social media data, but social media is extremely disorganized data source. So, what you're trying to do when you're creating scoring models, and I'll get a little technical on you, but, you might appreciate the math. Like it's X and Y, right? So you're talking about predictors and, the variable that's being predicted, right? So in order to have a stable correlation, what you need is a large data set of matching X's and Y's, right? So you need the same set of fields here and the same set of fields here, and then basically you're looking for those correlations, right? When you think about Facebook, it's such an unstructured thing in terms of data fields that it's really hard to look for consistency. So that's why it hasn't really been that successful. Some of the more successful data sources, telco is a pretty successful data source. Telcos have a lot of data that's very relevant, and the data set is full. So we've done in the early days in the bank that I built in Europe, we've done actually the test before big data kind of became the big data. We've done a test, back test with the telco, where we took our clients that also happen to be their clients. We counterimposed our sets and said, okay, could your data have predicted that the client is going to go bad?
Yeah.
And we said, wow. So like our scorecard was already pretty good. Was Gini coefficient about 55? Sorry, no, it was in the 40s. And then we lifted that above 50, which was actually a really, really good result. We increased, just on a pilot, we increased the quality of our scorecard by about 20% by just adding the telco data. The banks have really good data in the current account. That's very, very predictive. Few of them know how to use it. And the device data is a super data source. After those two, the device data is really, really good. So with purely device data, you can squeeze out, low 40s type of a Gini coefficient. When you add to that the demographic scorecard, the data that you get from the application, male, female, education level, number of kids, etc. When you put those two together, you get really high quality scorecards. So.
Okay, but I'm sorry, I don't understand how the Gini coefficient works. I remember that as being a macroeconomic indicator of income inequality.
Yeah, Gini is basically also used in credit risk management as an indicator of the quality of the scorecard. So how well the scorecard differentiates the good ones from the bad ones. Yeah.
Sure. Okay. Understood. And circling back to a point you made previously about the disorganized nature of social media, but then we have guys like formerly Cambridge Analytics, who seem to have been able to do something with it. So you don't think that same machine learning can be applied to banking?
Yeah, it's a little different. Look, what these guys have used is they've used the Facebook data for targeted advertising.
Yeah.
Okay. That's different than using it for credit scoring, because using it for targeted advertising is you're saying, okay, there are people that have expressed these types of things on Facebook, and for that group, it's like sentiment analysis, right? So that have expressed these types of sentiments, they can be psychologically receptive to this type of message, right? So it's easier to sell to people based on that data, and that's why Facebook is making so much money. Right, because they're the second largest advertising company in the world, I think. So it's basically down to advertising, right? It's an ad technology, ad tech. And it's a little different than how you build the credit score. Because for credit scores, you need a very consistent data set of the axis and a large quantity of the quantity of data of that.
Okay. All right. That makes sense. Now, again, so I'm going to jump forward a bit. On looking at the future of banking. So we discussed retail banking being under threat. And I've been seeing commentary in some of the, I guess for the want of a better word, alternative media on the whole digital currency space. And well, forever people have been crying down fiat currency and the end is nigh, especially the gold bugs. They've been looking for any excuse. But they're talking about what's going on now in the US, where the latest rounds of helicopter money is going to come in the form of some sort of digital payment or digital wallet, I don't know. And that once governments begin to embrace that, then the fiat currency model would then see the end of its days. What are your thoughts on that whole prediction, whatever? Is that real or is that nonsense?
Well, look, fiat currency basically is created by not even the government, but by the banking sector.
Right.
So the magic happens at that level, and so that's why the banks are like so critical for the governments to like try to stimulate the economy. It's a lending that actually creates that that money supply.
Yeah.
Right. So I don't think that the move of the government to clearing purely electronically instead of like printing money physically, I don't think that on its own is going to be a major influence on the dynamics of the fiat currency. I think the fiat currency, its credibility is driven by perception. It's a confidence game, right? It's all a confidence game. Fiat currency depends on the population believing in the credibility of the issuer And if that's not there, and if that starts getting eroded, then fiat currencies get in trouble. And many currencies that people never thought would get into trouble got into massive trouble over the years. Again, you need to look at history. I love reading history because I really believe that history, repeats itself, and it does so a lot. And most people in our generation don't remember because we weren't alive 50 years ago, right? And the number of people that have read about it is a very small minority. For everybody else, it's like, oh, I've never seen it, so like, it's like COVID. We're all like freaking out about it. Guess what? Happens pretty much every few generations. So it's just like, duh, you get a lot of people together, packed in, and it's like, okay, you get a lot of salmon together, you have to sprinkle some antibiotics on them to make sure they don't all die, right? Same thing with humans, right? We're all packed in these. Eventually, something like this happens. Guys like Bill Gates have been talking about this forever, right? But hey, it's a matter of time before the next one hits. So I think like history repeats itself, right? Fiat currencies, they're ultimately they're all prone to this, crisis of confidence. Don't manage it proactively, the confidence level, and if you continue to undermine confidence, like the U.S. is doing right now, that's asking for trouble. Yeah.
So invariably, but one fiat gets replaced with another, right?
Yes, or for a period of time, you might have, the gold bugs declaring temporary victory, and I told you also, why don't you own some gold coin and gold slabs and all that, and I can't say they're wrong, it's like in those times, when you don't have a sovereign or another credible printer, then people revert to precious metals.
Gotcha. Okay, Greg, thank you for sharing so much insight. So if I'm to summarize what I took away from this, pay attention to history because it certainly does repeat itself. Be optimistic, hope for the best, but prepare for the worst. That's the way I see it. Greg, thank you for your time. It's much appreciated.
Sure, Derren. My pleasure.
Please subscribe, like, share, and comment below. Our books and upcoming event are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.